Okay, well, welcome everyone to our third webinar in our series with Tom Shay. He's going to discuss the cost of holding debt and inventory today. I'm Brianna Hall. I'm the marketing manager for Iowa SBDC. This will be recorded, so we will have this up on our YouTube channel after the fact if you'd like to share it with anyone else. We do have one more webinar in our series next week on Tuesday at 8:30. So I'm just going to let Tom take it away this morning, and thank you for being here.
Well, good morning, everybody, and thank you for coming and being with us. I've got a great lesson to share with you today. It's an important one, and from the times where I have got to share this lesson both in a live and a virtual format, I found that people walk away with eyes open in a bit of shock, shall we say, with a, oh my gosh, what's going on here? What's happening in my business? So let's start right off the bat. You've got a document, we call it a balance sheet. I am hopeful that you get one, whether you prepare it or someone prepares it for you every month. It has on it, here's your assets, here's your liabilities. Assets are what your business owns. Liabilities is what your business owes to somebody. And then in the bottom section, there's a thing called, for many of us, contributed capital, current income, retained earnings. This is the part that's talking about you, the money that you have invested in the business. And very few people look at their business from the standpoint of wanting to know what's their money doing for them. And in our time today, I'm going to show you what our money is doing for us, but I'm going to show you what's more importantly, what can we make our money do for us instead. So you have these liabilities. You know, maybe you got a mortgage for your building, someone's loaned you money, or a bank has loaned you money, and you're probably aware of what the interest rate is that you are paying for this. And you also have an idea as to what does it take for your business to repay that money, okay? Because parts of these, the interest on these, interest part of these liabilities shows up on your income statement as an expense. So as you know what this money is costing you, I'm wondering if you have ever thought about what are you expecting for all of the stuff that you've got in the business. When I say the contributed capital, in other businesses, it's called net worth or stockholders' equity, some form that's simply describing you, the owner, how much of the business actually belongs to you. Or perhaps we could even look at it if we simply liquidated your business, and this is what's left on the table, what would you do with it? Okay, so we call it ROI, return on investment. What's the ROI that your business is producing for you? And for many of us, the inventory is the biggest investment we got. I do see cases where someone owns the building and the building has more of a value, particularly in today's times with prices of all kinds of structures going up. But for most of us, the inventory is the biggest asset you've got. And you ought to know, what is it doing for you? What's it making money for you? So if we were to take the money and go invest it in something else, you'd ask a banker, you'd ask a stockbroker, a certified financial planner, someone to tell you, here's the rate of return your money is going to get for you. Now what we want to do is look at that inventory in your business and go, what is it doing for you? So as we look at the inventory that sits there, that gets old, it shows. I mean, it has that look about it, that it's been sitting there on the shelf. Not necessarily that something that's white is now turning to ivory and going towards tan because it's getting older, but it just sitting on our shelves. And particularly for your frequent customers, will they come back and say, I saw that last time I was here. I saw that the time before I was here. The stuff is just sitting here. It's a distraction from your business. And then things like this, when stores start putting up these signs, I guess it's because I've been in business all of my life. I'm the fourth generation of my family, that when I see signs in a store that's red and yellow, I start cringing. Now, I realize the people who are price shoppers are coming running to something like that. And I'm not a business owner that I want to make a point to attract the price shopper, the one who's coming just because I'm having a clearance sale. But red and yellow to me is just not good at all. So we're going to look at the concept today of getting rid of the dead inventory. And in doing so, I'm going to approach it in a very unique method. And that is, I'll spend a couple minutes talking about some ideas to get rid of dead inventory. But what I have found in having created this class is that I seem to do a better job of getting the point across to people when I show you how much dead inventory is actually costing you. In a live setting, it's fun to watch because I see people moaning, cringing, going, oh my gosh, oh. And particularly if we have partners in a business or husbands and wife in a business, and one of them starts elbowing the other one, and you get this, see, I told you, see, we got to do something about that. So to some degree, I want to kind of push a bit of, shall we say, hurt in your direction, that this will prompt you to say, I've got to do something with it. And with some of the previous classes and the subsequent classes that we're going to have here, I'm going to do so using one of the free calculators on our website, profitsplus.org. So for those who, this is your first time with me, profitsplus.org is the largest website that exists out in the small business world. Everything is free on it, okay? You don't have to sign in for anything. You don't have to buy anything. There's nothing for sale up there. It's just lots and lots of information. And today we're going to focus, to start with, on one of the 47 calculators that we have on the website. Okay, this is what the thing looks like. And let's see, right here, let me drop this in again for everybody. There, if you look in the chats, this is the page that I'm on our website. This is what the calculator looks like. And we're going to insert numbers into the yellow spaces. And where you see those dark zeros in black, we're going to pay attention to what those are, because that's going to be the telltale sign about your business. So let's move on and take a look at we're next wanting out of this calculator. I need to know your total sales. I would say at this point, let's go back and look at 2020. Okay. If 2020 was not a good year in your business, I'm thinking particularly people who are bicycle stores and liquor stores and fabric stores, several others. Okay, it was a great year because of the pandemic and that people couldn't go as many places they want. For others, particularly in the restaurant business, it was a tough year. So maybe you'd want to get an idea of this by looking back at 2019. So I need a bunch of sales, whatever they are. I need to know what percentage of your sales are credit. All right, so let me explain credit. This is not Visa, MasterCard, Discover, American Express. This is for the business that has what we called in my business, house charge accounts. People that come in, sign a ticket, and at the end of the month, you send them a bill. All right, so if your number for you is 0, if everything in your business is cash, check, or credit card, then your percentage of credit sales is going to be a 0. I need, for the same time period that you gave me total sales, I need to know the cost of goods sold. All right, for most of us, here's what we're looking at. Total sales and cost of goods sold are on your profit and loss statement or your income statement, whatever you and your accountant call it. Total sales is generally your first line of information, and your cost of goods sold is generally, it's the second line of information on this document. I need to know the total of your operating expenses. Okay, this is like way down the bottom of the page, frequently 2 or 3 lines up from the very bottom, but it'll say total operating expenses. And again, like total sales and cost of goods sold, I need to know operating expenses for the same time period. Tax rate percentage. Okay, this, for most of us, this is a quick call to the accountant. Why am I putting this in here? I'm doing so with a little bit of a grin added to it, but a belief that a business that will make these changes could actually find themselves being so much more profitable that you're going to push yourself into a new tax bracket. Okay, so why would I want to be in a higher tax bracket? Well, you don't get a choice. It's not that you want, other than the fact that you're making so much more money, pushing it down to the bottom line, that this is going to take and affect it. So let's, just to play along with me, let's look at it. I need to know your average inventory on hand. All right, now, so I've underlined average. Let's look at how do I need you to create this. I need you to look at this. If we're doing this for last year, 2020, I need the balance sheet for each and every one of the 12 months last year, January through December. Up high in the section that's called assets, there should be a line there that says inventory. And I need you to take those 12 inventories of each of the months, add them together and divide them by 12. That's going to tell us what's the average amount of inventory that you had on hand throughout the past year. If you have those house charge accounts, if you had that, you have accounts receivable. Now, if your business doesn't have these, you may look on your balance sheet and go, but I have accounts receivable here. Let me explain what those are. If your business takes any of the credit cards, think about the last day of the month. All right, so let's look at this one, June. We get to the end of June, June 30th, you close up the doors. Technically speaking, accountants do this technically stuff. You have accounts receivable because the Visa, MasterCard, and Discover that you sold today is not in your checking account tonight. It'll be there in a day or two. So you have this very short-term accounts receivable. And for those of us who take American Express, which I wholeheartedly endorse, because the average person who buys with an American Express card outspends your other customers. I realize that American Express pays slower. I realize they have a higher rate, but I'd rather take and pay a higher rate than to not have the sales. And I hear people who come back and say, well, no one's ever asked me for it, or I've never lost a sale because I didn't take American Express. Okay, truth is, you don't know if you've lost or not. For a person may simply say, I didn't see anything I liked. Well, in truth, they're walking out because they have an American Express card and you don't take it. So they have no way of paying for it. So that's how the accounts receivable is calculated on average. Same thing, 12 months, add them together, divide by 12. What other current term assets do you have? Again, we're on the balance sheet. From December 31st, the end of the year, I need to know what's the amount of cash sitting in the checking account. We need to look at the long-term assets. All right, so let's have a quick side note on current term, long-term. Current term assets are anything your business has that is expected to be turned into cash within 12 months. Not the calendar 12 months, but the next 12 months coming up, whatever time period that is. So that would be things like cash in a checking account. That would be accounts receivable as a type of current asset. Your inventory is a current asset. Your long-term assets, things that are not going to be turned into cash in the next 12 months, okay, we refer to those as the items that are going to be there for a while. What would they be? Your business own a vehicle? Your business own the building? Do you have fixtures? Do you have equipment? Do you have a point of sale system? All of this type of stuff. Are you a car service business? All right, all those tools that you have, those are long-term liabilities. They cannot easily be converted into cash. This is the differentiation. And why knowing how this works and your understanding is important, because anytime your business goes to borrow money, a lender is going to look at current liabilities and long-term liabilities, and you need to make sure that you know which is which. Well, wait a minute. Isn't my accountant watching this for me? Trust me, your accountant is not coming into your business, taking an inventory of everything's there and looking at it that way. There is a hope, an expectation that when they were put in there into the system initially, they were done correctly. Let's just make sure. All right, let's go to my pretend business. And I'm going to share with you the numbers on this. This is a pretend business. I need your numbers. Here we go. $875,000 in sales for the year. Number two, what percentage of my sales were on the house charge accounts? I said 12%, for example. The cost of goods sold over the course of this year was $460,000. All right. Let's take a little side note. I don't have this in the slide, but let's make sure while we're discussing accounting, let's just make sure we're all on the same page. What's cost of goods sold? It's a calculation. And I think of it because I have seen in recent weeks a couple of financial statements that I could easily tell it wasn't being counted correctly. The sad part is this business owner gave me the financial statement that came from their accountant, and the accountant wasn't paying attention to it. Cost of goods sold is calculated this. How much inventory do you have on hand at the beginning at cost? Add to that number, how much inventory did you receive? Okay, now hear the word receive. This is not how much inventory did you pay for. This is not how much inventory did you order. Okay, this is how much additional inventory during the time period did you receive. Add beginning inventory and inventory received together. Subtract from that how much inventory was there on hand at the end. And this is all inventory at cost, not retail, at cost. When it's done properly, we get a good solid financial statement. When it's not, an example was a lady who owned a business, and I looked at about 12 of her financial statements and I go, this is gibberish. Well, the sad part was the accountant was on the second floor of the place where her business was. And I said, this can't be right, because 1 month your gross margin is like 10 or 15%. The next month it's like 80%. Another month it's 60. Her margin was bouncing all over the place. Now, for most all of us, a margin might move a point or two up and down, but it doesn't jump. And if it is jumping, it's a pretty good indicator that someone is not calculating things correctly. More likely what they're doing is they are plugging in the amount of inventory that you paid for, which is an extremely incorrect number. Why would you like it correct? Well, there's a good chance that in paying taxes, you're reporting a whole lot more profit than is there, and that hence your tax bill is going up. Let's look at the operating expenses. $340,000 for this same time period. The tax rate, I just plugged in a number of 20%. And the average inventory on hand, okay, was $250,000. $250,000 average inventory. The average accounts receivable was $19,500. There was $7,000 sitting in the checking account. The long-term assets in my sample business was $175,000. Their current liabilities, again, bills to be expected to be paid within the next 12 months, 365 days, $23,000. Long-term liabilities, $125,000. So while I simply made up the numbers, I'm going to take a look and guess this and say, this is a building that they own for probably $150,000, and they've got a mortgage on it, which is probably about 120, and the other 5,000 could be things like a point of sale system, some fixtures. Let's look at what does this tell me about this business. Okay, this business has a gross margin of 47.43. What does that mean? What's gross margin mean? Let's look at selling merchandise and services like a pie, okay? Big round pie. Pick your flavor, chocolate, cherry, whatever you like. That's 100%. Sales are 100%. And when we operate a business, we begin to start cutting out slices. The biggest slice generally goes to pay for the inventory, right? Well, in this case, it's about 53. It's the inverse of the 47. So when we take the slice of pie out to pay for the inventory, 47%, so we're a little under half the pie, that's the gross profit that we've got. Gross profit, we stated as dollars and cents. Gross margin, we state as a percentage. So 47% of the pie that's left is yours to go pay all the bills. What are the bills? Our sample business, it's 38.86. The net profit, 6.86. All right, let's put it in just real easy numbers. Of every $100 that you sell, $6.86 goes to the bottom line. After everything's been paid, $6.86 is what you are keeping as profit out of a $100 sale. Here's an important number that's going to play to where we're going to go today. Inventory turnover, 1.84. Okay, what does this mean? How fast are you selling inventory? If I buy, let's say an item, I sell 12 of it a year. If I buy 12 to start the year, my inventory turnover is 1 because I bought it, and over the course of the year, I sold the very 12 I bought. If on the other hand, I buy 6 at a time, and when I'm down to, say, I've sold 4 or 5, I buy again, I've got an inventory turn that's about 2. A business that has an inventory turn of 2 is going to make more money than a business that's got a turnover of 1, because the business has more freer money by having a higher turnover to offer other products and services to their customers. Let's punch in the rest of the numbers I'm going to show you. The accounts collection days, again, this is for people who have charge accounts, was 66.86. What does this mean? This means that you're selling something and it's taking you just over 2 months to collect your money. You're giving your customer a 2-month interest-free loan. Add to that you bought the merchandise, have already paid for it, it's probably well over 90 days. You may think you're a business, but in effect, you are an interest-free bank to your customers, and this is costing you. Hence, this is another important number to pay. Return on assets. We looked at the balance sheet. The top part had our assets on it. What's the rate of return they're earning us? 13.29. My financial leverage is 1.49. Okay, what does this mean? It means for every dollar I have invested in my business, I'm controlling $1.49 worth of assets. Okay, this is good. I'm controlling more. I'm learning how to leverage myself. And as a business owner, I want to see this number go up. It's one of multiple, what they call KPI, key performance indicators, that tell us the health of a business. The important reason why we're doing this webinar is that we as business owners need to understand this stuff about our business. All right, here's the big number, 19.77. This business we just looked at had a ROI of 19.77. You want to see if this is good or not? You want to determine whether or not you're pleased with it? Go call the bank. Tell them you're going to take $75,000 and you want to invest it in the bank. What are they going to pay you for a return? I'm going to guess it's going to be less than 1.9. So that's a whole lot less than this one. Go to an investment counselor. I'm pretty well expecting they're going to tell you, while 2021 is exceptional, that this is going to be a single digit, maybe an 8 or 9% that you'd be really happy with. Your business, though, is what we're talking about, and it's a 19.77. So as we look at this, are you pleased with these? Are you pleased that your business is producing 19.77, that your business is outperforming things like the stock market? Don't answer that question yet. Just think about it. All right, here's the numbers. This slide, here's all the numbers plugged in, all right? So that you can look at that. And once again, I will go over here and say, all right, where are we? We're at this page on my website, and no, there are no numbers when you get it on the website. It's just all zeros. These are just the numbers from the example I've given. So as you see, we put in the yellow numbers and the the black numbers in bold. Those are the items that we just discussed. Those are the answers. Hold on to it, see what your business looks like. Now, I'm going to take that business and I'm going to change it. I will make a few changes to this business. Not creative accounting ones, just changes that you can make. I'm not going to change the sales. I'm not going to change the credit sales. What if we worked on how we buy and we were to take and bought just a little better, learning when to package the deals right with our vendors. And I will share with you, there's a couple of calculators on our website that address this issue. Like, should I be buying in quantity or should I be buying on a onesie basis? Again, 47 calculators that help you get the absolute answers to all these, not just it sounds like a good idea. Decisions should be made with information, not guesses and not old retail adages. The operating expenses, $340,000. And what if I could lower $20,000 a year? Walked into a business the other day, air conditioner was set at 70 degrees. How much is that costing them to cool that whole building? It doesn't need to be 72. Well, it's 85 or 90 degrees outside. You get it up to 78 or maybe even 80. It's comfortable. It doesn't have to be an ice chamber. How about your lighting? How about your insurance? When was the last time that you sat down with the insurance agent and said, let's look at this? When's the last time that you actually shopped the insurance for your business? Not the idea that your agent is an independent, but to someone else who represents different lines to say, am I getting the right thing? Have I purchased the correct insurance? An example, in some states, the owner of the business does not have to file for or pay workers' compensation insurance for themselves. The logic behind in those states, and I do not know if Iowa is one of them, is that if you as the owner of the business got hurt in your own business, you're going to pay yourself your salary. You're going to keep paying yourself a payroll. With the employee who got injured in your business, that's what workers' compensation insurance is for. Hoping that you as the owner are the person who's getting the biggest paycheck. If you're going to go ahead and pay yourself, if your state allows, why would you take and buy insurance that you're never going to make a claim against? The tax rate, I didn't change it. It's 20%. I didn't change the inventory on hand. What have I done? Little bit of cost of goods sold, little bit of operating expenses. All right, why do I focus on these? Because there's one of these old retail adages that says, how do you make more money in your business? They always tell you 3 ways. Increase your sales, increase your margin. Okay, that's what we did with the cost of goods sold here, and decrease your margins. So we did 2 out of the 3 because those are the 2 that are easier to do. Granted, increasing sales is the bigger challenge of them. I didn't change the accounts receivable. I didn't change the cash on hand. I didn't change anything about the building. I didn't go back and say, let's go back and remortgage it or anything fancy like that. What do we get for results now? My margin went up 1.14%. Now, many people go, oh, it's just 1%. In a moment, you're going to see this is big money. The operating expenses went down 2.29. Big change. Big change? Absolutely. I was making $6.86 out of every 100 I sold. Now I'm making $9.60 out of every dollar. Okay, folks, we're getting into a business here that it's cooking. It's doing good. My inventory turnover has slightly turned down. I'm not worried about it at this point. Why am I not worried? Because when I learn to decrease my cost of goods sold, the math changes the turnover ever so slightly. So because of the other changes I've made, I'm not worried about it. I didn't change my collection days, although I will tell you that a lender is going to look at it and say, that's not a good number. I expect your lender is going to tell you the answer needs to be less than 45. Return on assets. We've gone from 13.29 to 18.6. All right, so when we look at this number, the return on assets is changing for us. When we look at the things like the net profit, we see a business that is getting healthier and healthier. Not that it wasn't healthy to begin with, but we got a business that's making some progress here. And an accountant's going to look at it and say to the owner, what are you doing here? You're going somewhere. Financial leverage did not change a bit. Hey, remember a while ago, I asked you if you were happy with 19.77 return on investment? And some of you, I'm sure, said yes, because when I say this to a live class, everybody's, oh, yeah, that's great. When I look at the stock market, this is really great. Look what we just did. Almost 8 points higher. It's growing. All right. So I'll ask you again. Now are you happy with these numbers? All right. Well, mind you, we're only up to about the top of the hour here. So the answer really needs to be no, because there must be some kind of surprise I'm holding in my back pocket for you to go, oh my gosh, why would I settle for a business like this when I could have all the other stuff that Tom's going to share with me? You got it. Here's my numbers. Here's what they look like. The important number I'm tracking at this point is 27.68. Again, did it by only doing 2 out of the 3 things: improving my gross margin ever so slightly and decreasing my operating expenses. So they're important. Sales can make a difference, but the factor that's going to drive our business, the factor that no one ever looks at or discusses, is that dead inventory sitting there. The stuff that just sits there and celebrates a birthday with us. I can remember speaking at a conference in Atlantic City several years ago, and we're discussing dead inventory. And this was a group of stores that sold pool chemicals and supplies. And a person made a comment about they had come in as the new manager of the store, and they actually found items sitting in the store that were 10 years old. And my thought is, are you a store or are you a museum? And, doesn't some of that stuff have a shelf life at some point in time? And they were looking for ideas. How can I take and do something different here that would take and make a bigger difference? And how do I get rid of this stuff? All right. So let's take it where we left off. The second example, I'm looking at the bottom right number, the 27.68. We were before that at the first example at 19.77. So let's look at this one, and let me ask you a question about your business. I want you to think about the inventory that you've got on hand. I seem to always get the same answer of yes, but I'll throw it to you this way. Do you think that you've got dead inventory in your business? And then I'll say, how about 15%? Do you think that 15% of your inventory is moving a whole lot slower than it needs to move? And again, the general answer I get in a live setting is, oh my gosh, I wish it were only 15%. It's a whole lot more than that. And I have had people sitting in the audience, I can remember in a person's trade show, and the person who was the head of this wholesale company came up to me after the session and goes, oh my gosh, he says, I've got so much dead stuff sitting in our place. And he says, this so applies to us. We've got things sitting there and it's just not moving. All right. So let's look at what we had for inventory on hand. It was an average of $250,000. Okay. That's $37,500 of dead inventory. Let's look at it this way. Remember the story about grandma taking her money and stuffing it under the mattress? Remember the story about the person who takes the glass jar or the tin can and puts their money in it and goes out and buries it in the backyard? And we laugh at those two situations and saying, hey, you need to invest that money. Okay, if 15% of this $250,000 of inventory is sitting there and doing nothing, we're doing exactly the same thing. We don't have a mattress. We don't have a glass jar that we buried in the backyard. We have shelves, and we have $37,500 worth of dead inventory sitting on the shelves with the hope at some point in time someone's going to buy it. And I understand it, folks, because I've been a buyer in my own business, and I look at it and go, but this was neat stuff. I bought this. And if people don't buy it, it's a personal reflection on me. It makes me look bad. No, what makes you look bad is the stuff still sitting there. You're taking a gamble anytime you buy inventory. And when it doesn't work, it needs to go. When I was a kid, my dad was explaining this to me. He asked me, what did I want to do for a living? I didn't know. He says, let me tell you the neat thing about being a business owner, son. He says, you buy inventory with the expectation someone's going to buy it. And if they don't, that's okay. You've made a mistake. So what you do is you get rid of the mistake and you move on. And he says, if you do it right, not wait forever and ever, you can get your money right back out of that. You could sell this stuff at cost and you put that money back into your business. Well, initially, we're going to put it into a checking account. We're going to discuss that. What's going to happen if I simply cleared off this inventory? He says, that's the neat thing. He says, business to a person who works it right is very forgiving. It forgives the mistakes you make and allows you to take and simply just move on from there. All right, so let's look at our business, our $250,000, our $37,500, and I'm fine with it at cost. If you can get more for it, good for you. And if you get less for it, okay, then that's going to happen too. But let's see what happens if we put this money back into action. Let's see what's going on. Let's see. Let's start at the top with the red circles. All right, the inventory turn was 1.8. At its worst, we had it at 1.84, but we had it at 1.8. Now our inventory is 2.12. Why? Because the 37,500 went away, and now this is active inventory. So what we can realistically say is the inventory in our store sells at about a 2.12 turn, not a 1.8. Next red circle. The $7,000 that was in the checking account is now $44,500 because, as I showed you on the previous slide, sell the stuff, put the money in the checking account. But this is the downside to it. This is why this is not their way to do it. See the bottom right corner, 27.68. We're not making any more on it. We're not making any more profit. We're not getting a better ROI because money sitting in a checking account is doing nothing. Now, I'm not saying strip out the checking account to $1 from the 44,500. I'm saying when you sit with chunks of money in a checking account and it's doing nothing, nothing's happening. I had dinner one night with a small shop owner in California. We talked about numbers, and they were a very profitable business. And then out of the blue, we were discussing financial management aspects. And this person says to me, I have a personal line that I've drawn in the sand, so to speak. And that is, I keep $100,000 in my checking account at all times. I go, how much? He goes, $100,000. I sleep better knowing that I've got that much cash on hand in my business. I said, can I make a suggestion about that sleeping at night? He goes, yeah. And I said, Benadryl. Go to the corner drugstore and buy some Benadryl. It's a whole lot less than $100,000. My friend, I don't know what the number is. It might be 20,000. It might be 30,000, somewhere there. But you don't need in your business $100,000 sitting there doing nothing. You could take a big chunk, if nothing else, settle for half of it. Take $50,000, and the way you are as a good owner, invest that in other aspects of your business and start making money on the 50. Because even if you have an interest-bearing checking account, What are you getting out every month from the bank? 15 bucks? That's it? So this is the problem that's going to occur when I simply take and put the money from dead inventory to a checking account. There's a lot of relationship. Dead inventory, money in a checking account. Neither of them are doing anything for the business. Nothing good at all. All right. So let's look at my scenario like this. I was okay with the 7,000 I initially had in the checking account. Was comfortable with that. Didn't need the 100,000. Didn't need the Benadryl. And I'm going to take the 37,000 and I'm going to buy inventory that moves and has the same 2.12 inventory turn. Okay. What does that mean? What will it get me? What's going to happen? Now, here's the issue. I want to take and make sure that I'm doing something that the inventory is moving. Here's what the numbers look like. All right, let's just start at the top, and then we're going to explain it and then give some examples of stuff. Look at the top line. If I take $37,500, put it into inventory that moves at the same 2.12, mind you, I'm not borrowing money from anybody. I'm just taking dead stuff off my shelf, getting rid of it, and buying something that sells. Our store was at $875,000 in sales. Doing so, our sales are now $1,008,200. Folks, this is not playing around with numbers. This is just simple being a good business owner. I did not change the gross margin. I left it at 47.43. The business when we started out was making $84,000, and now look at your profit. $158,200. Not quite doubled the amount of profit, all by knowing how to properly invest $37,500 and invest it in your business. The 2.12, that's the number that we've made consistent with because you've already shown me in your business you were doing a 2.12 turn just when you got rid of the dead inventory. And bottom right, didn't we start at 19.77 and we were happy, and we got to 27.68 and we were happy? Look at the return on investment now, 41.7%. 41.7% return on investment. We were doing 19.77 and we were making $84,000 a year in the same building, the same space, the same operating expenses, the same everything almost. We have gone to where we have doubled the return on investment and we have almost doubled the net profit. Pretty cool, huh? All right, here's the caveats that's necessary to make this thing work. When I said put the 37.5 into additional inventory that moves and it has the same 2.1 turn, this means you do not, absolutely do not go out and buy more of what you've already got. If you have an item and you say, well, we sell a lot of this, so let's just buy more of it, your inventory turn is going to go down. I'm happy with the 2.12. What I want to do is, what else could I sell? What else could I add to the mix at this point? Invest it in different products, different sizes, different colors, different somethings out there. But this example does not work if all we're doing is turn around and buying more inventory and deeper. Granted, if you run out of stuff, okay, if I got things I run out of, I'm going to make sure I got enough on hand. So I'm not having to tell a customer, come back in a week or so. But it means go and explore, try something different. So then the question is, well, how do I buy? Well, there's a calculator on our website and it does this for you. Do I buy in quantity or do I take and buy as I needed? All right. Do I need to take and be adding, I'm buying 6 at a time Should I get a discount because I buy 20 at a time from some vendor? Something like that. What does that do? This calculator that we have online will do it for you, tell you which way works, and it'll calculate up for about 8 months of inventory. All right, what have I done? In the few minutes I got left, I hope I've made you cringe. I hope I make you today go into your business and look around at stuff and going, oh my gosh, how much is this stuff costing me sitting here? And if I've done that, I've achieved what I came to do. But now I got to take and share with you a couple more slides that I want to take and give you some ideas. Number one, never have a closeout corner in your business. Okay? Never have a part of the store where things go to die. I didn't put them in because of time restrictions, a couple of slides. I had one from Crate and Barrel, and I had one from Williams Sonoma. Ugly back corners of their store with junk piled in there. And they go, well, why shouldn't I do it if they're doing it? Nothing says they know what they're doing. Closeout corner is not attractive. And because you are operating with lower margins on that stuff, the cost of your employees and the cost of your other operating expenses did not go down. Only thing a closeout corner draws up is something like this. This is a catfish. So the ongoing joke in our business with this, what's the difference in a price shopper and a catfish? And the answer is, one of them is bottom feeding pond scum, and the other one is a catfish. Yes, I'm calling a potential customer bottom feeding pond scum. I don't want that person. I don't want to do anything that attracts the bottom feeder to come to my store. All they're doing is going from store to store looking for what's being put on sale. Never have a true closeout sale where, this is what's killed in America today, small towns having really neat sidewalk sales. Because they look nothing more than someone's yard sale on some street corner in the front house. They're selling stuff that's been in their house for years. And when people had sidewalk sales in small towns, the sidewalk sale looked nothing more than like an overgrown yard sale. Just stuff had different kinds of price tags on it. No, talk to your vendors. Remember I gave the example about the vendor who had the comment at the end of a class and said, I've got all this stuff out there. When you plan when you're going to have sales events, you call your vendors well in advance and say, hey, I've got $3,000 as an example, $3,000. I'm looking for some special deals. What do you got that you want to get rid of? One person's trash may be your treasures. Take a look at doing that. And that way, when you have your sale, it's always got fresh inventory added to it. Bundle items. So we would take, in ways of getting sales, we would take a box, okay? Cardboard box, cut the top off, gift wrap it to make it look pretty, and put a whole bunch of stuff in it. Take off all the sales stickers, put in one nice, neat, here's the price of it, clean, white looking price tag with the full price on it, and put a bunch of stuff in it and say, hey, everything in this box is $50. Everything in this box is $100. Oddly enough, in our store, we found that the higher the price of the box, the more people wanted it. Oh, and then by the way, since you've only got 5 sides of the box, the top of the box, we seal it with saran wrap. Customer can look in it and they pick up the box and they shake it and turn it and look at all kinds of stuff and go, hey, you get the whole box, $75. Great way to move dead inventory. Another one, sticker dots, those little round like Avery style dots. So we have a sale and we have this table with all kinds of things we want to get rid of. Again, we've taken off the price stickers from them and we put on dots, and our sale would go like this. Come into our store and buy $30. All right, well, we already know that our average sale is like 25 bucks. So what we're doing is pushing the customer to spend another $5. Spend $30, and on the table, you can have any one item on that table for only $5 if it's got a red dot. Spend $60 with us, and you can buy 2 Avery dotted items for $5 each, or you can buy a blue dotted item for $10. And you continue it. Then we got a series of yellow dots. So you can have 3 reds or a blue and a red or a yellow, and that's $5 each or $15 for the yellow box there if you spent $100. What I'm doing is I'm trying to incentivize my customers to shop with me, and I'm using it to get rid of my stuff. People pick this up. We found in our business, we had to go and buy products from our vendors, whether we were doing the bundle sales or whether we were doing the closeout sale with the Avery dots on. We had to buy merchandise to have enough on it because we got that good at getting rid of our old stuff. Importance points as a buyer. Never fall in love with inventory. It's not personal. It's nothing personal if you don't buy it, okay? You made a mistake. Get over it. I've personally believed in my business, when I walked out of it at the end of the day, if the only way I had not made a mistake would have been if I had not gone to the store. I fully expect I go in and I make mistakes every day, every single day. Number 2 point, never buy inventory because you like it. So I go to trade shows, I walk around, I see people, and here's 2 people from a store. Ooh, I like this. Do you like this? Oh yeah, I like that. Ooh, I think that's neat. I really like that. I don't care if you like it. What you like is totally irrelevant. You buy it because the customer wants it. Okay, it's because it appeals to the customer, not because it's for you. Right? If you want it, buy one and take it home. Never let inventory celebrate a birthday in your store. Don't let it sit that long. How long should it be? It could be an item that it's got 8 weeks in your store and that's it. I mean, I'm thinking of, hey, we come to, I know it's starting to be summer, but somewhere along the line, it's going to turn into fall. And if I bring fall merchandise in and I get to where it's decently cool and we're somewhere late in September and I bought a dozen of it and I've still got 11 of it sitting on the shelf. Okay, it's time to go. It needs to be gotten rid of. There's nothing coming up. They've had cool weather and they haven't bought it. Get your money out of it and move on to what's next that you can do in your business. Closing points for the afternoon. That's for this morning, folks. Number 1, David Letterman, favorite philosopher. There's no business like show business, but there's a lot of businesses like accounting. This is accounting, folks. You're just doing it creatively with merchandise. We have to pay attention. Each of the factors that I've shared with you today are factors that should be very relevant and very personal to a person who's a small business owner, understanding how to make the numbers work, because when you work the numbers, that's what makes the money show up in the checking account. As always, I am an awesome fan of SBDC all across the United States. Here's my best advice. If you're not an SBDC client today, you need to be one. Oh, but business is great. Good. Sign up. Business is not good. Sign up. Your SBDC counselor can take and be helping you say, here's some other ideas you might try. Business is good. Let's make it better. Business is not good. We got a problem. Help you solve the problem. Don't wait for the problem to come. Don't wait for the good times to come. Meet an SBDC counselor. Have them know who you are and about your business, so that when you speak on the phone the next time, when you see each other face to face, right off the conversation starts with, we're going to work. Not, I don't need let's get together. Schedule an appointment. They're great folks, very good folks. If you have a question that you would like to ask me about what we're talking about today, if there's something that you got stuck on, even as Brianna has taken and recorded this, you call me, you write me. I will gladly talk to you. I will give you the time necessary, because to me, it's a compliment to find another small business owner that wants to go and do something great with their business. With that being said, Brianna, I'm going to hand it back to you.
Awesome. Well, thank you for all that very, very helpful information. That was awesome. I'll let just a couple minutes open for questions if you have any. If not, and you think of something later, Tom still has his information up on the screen, so I'll leave that up here. Just a reminder that we did record this, so this will be up on YouTube. And we do have one more webinar with Tom next week on Tuesday at 8:30. And that is the science and art of buying. So another really good webinar and a lot of really useful information. So make sure that you don't miss that one. Thank you so much, Tom, for being here and giving us a great presentation. And we're very thankful for you joining us today. So yeah, if no one has any questions, we'll just probably wrap this up, and then we will see you guys next week. And we're on YouTube. We do have a YouTube channel, America's SBDC Iowa. And I can also send out the link to after our presentation. After we wrap this up, I can send out an email to everyone with that link. Not a problem. Cool. Well, thank you so much, everyone. I hope you have a good rest of your day. Thanks, Tom.
Bye, everyone. Sure enjoyed it with you this morning.